On Monday morning, the Basel III deadline stops being a nerd topic and turns into a live grenade under the banks and under you. A rule with one boring name suddenly forces them to fund a big chunk of their precious metals book with long-term, stable money instead of cheap, short-term borrowing. Under the net stable funding ratio, most physically traded commodities, including gold, carry an 85% required stable funding factor, the same bucket as other commodities like corn or lead. That is not a paperwork tweak. That is a margin call on the people who control your deposits, your mortgage, your pension, and most of the silver price on your screen. Right now, almost everyone thinks Monday will just be another open, maybe a small gap, some usual noise. In reality, this is the day the referee walks onto the field and tells the banks, either you back this stuff with real metal or you pay through the nose. They do not have a clean way out. They can scramble to buy back paper, they can raid the physical market, or they can eat huge capital charges. All three choices hit you in a different way. In this video, I'm going to show you exactly how that 85% rule works, why it makes unbacked paper metal toxic overnight, how it can flip the silver and gold market from slow grind to air pocket, and what kind of person gets crushed when the banks start grabbing real ounces to plug the hole. This is not theory. This is written into the rule book. It is on a clock, and by the time you hear the watered-down version on television, it will be too late to be early. Stay with me, because by the end of this briefing, you will know what the banks are being forced to do on Monday, who is likely to get sacrificed to keep them safe, and what you can still change before that opening bell hits. In the next few minutes, we are going to talk about the new funding rule, the insane mismatch between paper claims and real ounces, the way algorithms have been used as a suppression tool, and how this all ties into a bigger shift where central banks and entire countries quietly moved into physical, while you were told silver was just a meme trade. And towards the end, I will show you the fork in the road that is opening up for you on Monday morning, and which type of person actually walks out of this with more purchasing power instead of less. Right now, it is Sunday, the 8th of February, 2026. In less than 24 hours, when the opening bell hits on Monday the 9th, the net stable funding ratio rules under Basel III stop being a distant topic on gold forums and start being the law that decides which banks are allowed to keep a license. Welcome to the channel. Here we turn the plumbing of the financial system into something you can actually understand and use. If you want someone to translate regulatory nonsense and back-end market tricks into clear, simple English, hit subscribe, tap the like button, and turn on notifications right now. You do not want to be the person who hears about this 3 days late from a headline that simply says, "Metals spike again," and misses the why behind it. All right, let us start with the basic paradox that nobody on mainstream television wants to spell out. On your screen, silver looks like another commodity with a slightly choppy chart. In the real world, the people who write the rules for banks just change the classification of most of the metal on that chart from comfy and cheap to radioactive and expensive. Most people think gold and silver are just tickers on a screen, moved mostly by sentiment, inflation headlines, and whatever the Federal Reserve Chair mumbles in a press conference. In reality, there are two different metals markets living on top of each other. One is the paper world, full of futures, swaps, and unallocated accounts. The other is the physical world, where bars and coins actually sit in vaults, trucks, and safes. Basel III's net stable funding ratio was not written just for gold and silver. It is a broad stability rule. But by making it more expensive to fund big, leveraged commodities books with short-term money, it indirectly puts pressure on the most aggressively paper-heavy parts of the metals market. Here is the simple version. For years, under the older Basel rules, a bank could sit on a huge pile of paper metal obligations and treat them as fairly low risk. You could be short a mountain of silver through futures and unallocated accounts, and the regulators basically said, fine, just hold a modest cushion of capital and keep rolling the positions. That game is now over. Under the funding rule that kicks into full enforcement on Monday for the major American and European banks, unallocated precious metals exposures and trading books generally fall into higher required stable funding, less liquid categories, which means they consume more long-term funding and make large, leveraged positions more costly to maintain. They are now treated as high volatility positions that demand roughly 85 cents of real stable funding for every dollar of exposure. Let me say that in normal language. If a bank is effectively short $1 billion worth of paper silver, the rule expects them to match most of that exposure with longer-term, stable funding sources instead of overnight or very short-term funding. That can make running large, leveraged commodities books more expensive, even if nothing about the physical metal changes. Allocated bars, the real stuff with serial numbers in a vault, sit in a completely different bucket. For credit risk purposes, claims secured by allocated gold can carry a 0% risk weight, essentially similar to cash on that axis, and that has been the case since the original Basel rules. For liquidity and funding metrics like the net stable funding ratio, though, gold and other commodities still sit in a relatively expensive 85% funding bucket. So the incentive structure that let banks run huge synthetic metal books with a light cushion has flipped almost overnight. We will come back to what that does to their behavior, because it is the core of this whole story. But first, I want you to see the size of the mismatch they built before the rule changed. Picture the main New York silver futures market. On a typical recent Friday close, we are talking about open interest representing hundreds of millions of ounces of paper silver on the books. Each contract on that exchange represents 5,000 ounces, so even at today's lower contract counts, you are still looking at notional exposure in the 700 to 800 million ounce range. Now put that next to global mine supply. The entire world pulls roughly 800 to 900 million ounces out of the ground in a year. So just that one futures market is carrying claims that add up to about a full year of global mining output. And here comes the truly ugly part. The amount of registered silver sitting in the vaults tied to that exchange, the stuff that is actually tagged as available for delivery, is a tiny fraction of that. You are talking a little over 100 million registered ounces, not anything close to all the paper. Do the rough math with me. Hundreds of millions of paper ounces, divided by a little over 100 million registered ounces, still means several paper promises for every single real ounce that could be delivered from that pool. Roughly 4 to 7, depending on the day. That is not a one-to-one market in any normal sense. That is a giant stack of IOUs balanced on a coffee table. Under the old regime, the banks could shrug and say, "It is fine. Nobody ever stands for delivery in size. We just roll, hedge, and net everything out." Under the new rule, the regulators are asking a very simple question. If you are carrying that many obligations on your books, where is the money? Or the metal that proves you can withstand stress for longer than a weekend. That is what Monday is about. Now let us bring this back to what you will actually see on your screen and in the headlines. Yesterday, late in the American trading day, silver had one of those sharp vertical moves that everyone pretended to explain with a lazy headline. You probably heard something like, "Traders react to geopolitical tensions," or "Talk of inflation expectations drove safe haven buying." The same copy-paste phrases they use for everything. But when you look under the hood at who was actually moving size, the story is very different. Large blocks were ripping through the biggest silver exchange traded fund. Not tiny retail lots, not bored day traders. We are talking about institutional-sized chunks, millions of shares, in a narrow time window. Why does that matter? Because big banks that suddenly realize they have a regulatory hole on their balance sheet do not wander down to the coin shop. They hit the deepest and most liquid channels they can reach. That means the largest funds, the biggest futures venues, and the off-exchange forwards market. We need to talk about that because moves like this might include banks and large institutions repositioning around liquidity and funding costs. But from the outside, you cannot definitively say who is trading for what regulatory reason. What we can say is that big, clustered institutional flows into and out of the largest silver exchange traded fund amplify volatility. Before we go deeper into the plumbing, do me a favor. Hit the like button right now. Not for my ego, for distribution. When you touch that button, you tell the algorithm that this kind of analysis matters, which means more people see it before Monday. If you think regular people deserve to understand why their silver miner just jumped or crashed, instead of hearing some nonsense about sentiment, that is the quickest way to push this into their feed. All right, back to the pipes. At the heart of this mess is the way bullion banks in London and New York turned precious metals into a fractional reserve business. Just like old-style banking, where a bank could hold a small amount of cash and issue many more deposits, bullion banks built a world where unallocated accounts and derivatives represented many times the real metal in the system. On paper, clients around the world believe they own silver and gold through those accounts. In practice, Most of them own a claim on the balance sheet of a bank, not a specific pile of metal. As long as everyone does not rush for the exit at once, the illusion holds. The Basel III funding rule is not written as a silver conspiracy. It is a broad stability rule that grew out of the great financial crisis. Regulators watched banks fail because their funding dried up in a matter of days, even when assets looked fine on paper. So they built a ratio that forces banks to fund long-term assets with more stable sources of money. Here is the twist. When they finally decided where unallocated metals belong on that spectrum, they put them close to the danger end. High volatility, hard to fund in a crisis, heavy capital requirement. Allocated metal, on the other hand, went all the way to the safe end. So every bullion bank that has been leaning on unallocated books and short futures to keep the price tamed now has to either raise a mountain of fresh capital, unwind a chunk of their positions, or flip those paper exposures into real bars that fit the safe bucket. Those are the only doors out of the room. Let me spell them out clearly. Door 1, you buy back paper. You close shorts in the futures market. You shrink unallocated liabilities. You reduce the exposure the rule looks at. That means aggressive buying pressure in the very markets that set the spot price everyone watches. When large institutions all pull that move into a thin market, the result is not calm. You get spikes. Door 2, you source physical metal and allocate it. That might mean turning some of the unallocated pool into fully backed allocated accounts, or pulling from exchanges, funds, and refiners. Either way, you run into the hard wall we talked about. There are simply not enough freely available bars to match the scale of the paper pile. Door 3. You try to plug the gap with new capital. That means raising equity, shifting out of other assets, or leaning on central bank facilities. After the repo scares and regional bank failures of the last few years, that is not exactly a clean or cheap option, and it does nothing to fix the structural problem that the underlying exposures are still large and unstable. Most people think regulators gently nudge banks and everyone makes small adjustments over time. In reality, when a rule like this is finally enforced, it lands like a stress test with teeth. If you do not pass, you do not get a pat on the head. You get restrictions, higher funding costs, or in the worst case, you get shut out. Now layer one more thing on top. The way prices have been managed for the last decade and a half. If you look at intraday silver charts, you see those classic smash candles. Price grinds sideways, then out of nowhere you get a vertical drop that slices through support levels in seconds. No news, no big macro event, just a waterfall followed by a slow recovery. That pattern is not magic. It is the fingerprint of automated order engines slamming the bid with waves of contracts. High-speed programs can throw huge sell walls into the order book, freak out anybody holding a leveraged long, trigger a bunch of stops, harvest that panic, then quietly remove or reverse. Those engines work beautifully in a world where writing a new short contract is almost free. If the balance sheet cost of suppressing the price is low, you can lean on it as often as you like. But when every new short contract demands that 85% stable funding cushion, the economics flip. Spoofing and smash games suddenly eat real capital, and that is where Basel III collides with the algorithm. The structural villain in this story is not one politician or one central banker, although they all play their roles. The real antagonist is the incentive structure inside the big bullion banks and their trading machines. As long as suppressing metal prices made their other activities easier and cheaper, there was every reason to keep the weight on the market. Cheap silver helps preserve the illusion that the currency is strong, that inflation is under control, that there is no need for the public to seek insurance. It keeps industrial users happy, it keeps jewelry margins fat, and it keeps attention off the leverage hiding in the shadows. You, on the other hand, do not get any benefit from that game. You get fake stability on your chart and crushed rallies when you thought the breakout finally arrived. We need to talk about how long this split between paper and physical can last, because it is already visible if you walk away from the computer and talk to an actual dealer. Pick up the phone, call 3 bullion shops in different cities and ask the same simple question. Do you have silver on the shelf? And what are you charging over the quoted spot price? What you will hear, and what viewers all over the world have been reporting, is a version of the same answer. Thin supply, long wait lists, premiums that refuse to come back down even when the screen price dips. That gap between screen and street is your real-world signal that the official price no longer tells the whole story. It means that the people who actually ship and handle metal are already repricing the risk and the scarcity ahead of the charts you see in your app. This is not the first time we have been here. Go back to the early 1930s. American banks had played the same fractional game with gold, issuing more claims than there was metal in vaults. When enough people tried to convert paper into bars during the Depression-era panics, the system broke. The political solution was brutal and simple. Confiscate domestic gold, revalue it higher behind the scenes, and quietly recapitalize the banking system at the expense of citizens. Jump forward to the early 1970s. The Bretton Woods promise said foreign governments could redeem dollars for gold at a fixed rate. Again, the claims grew faster than the metal. Countries like France started calling the bluff by demanding real shipments. The answer was to close the window, default on the convertibility promise, and let gold float. In both cases, the pattern was the same. Too many claims, not enough metal, rule change that favored the system over the individual. What we are looking at now in silver is another version of that story, but this time the lever is not a presidential order. It is a stability rule written by the Bank for International Settlements in Basel and implemented through national regulators. Meanwhile, central banks have not been sitting still. Since the middle of the last decade, they have turned from net sellers of gold into aggressive net buyers. Year after year, official sector purchases of gold have run at levels not seen in generations. Emerging market central banks in particular have been swapping some of their dollar holdings for metal. On the silver side, large importing countries have quietly ramped up purchases that go well beyond jewelry or normal industrial use. In recent years, China, for example, has brought in thousands of tons of silver in a single year, adding up to a significant slice of global mine output. Some of that goes into solar panels and electronics. A meaningful chunk disappears into vaults and is not seen again. Ask yourself, why? Do you think these institutions are blindly stacking shiny rocks for fun? Or do you think they read the same rule books we are talking about tonight, understood where the incentives were going to land, and started positioning early? Most people think this is all wild internet theory. In reality, the regulators themselves have been telegraphing this shift for years through quiet changes in risk weights and asset classifications. They upgraded physical gold to the same risk status as cash. They pushed unallocated exposures into the danger zone. They ran crises in the repo market and the treasury market that showed them exactly how thin liquidity really is when everyone wants out at once. So where does that leave you on Monday morning? I see three types of people in this story. The first type looks at a weekend like this, shrugs, and does nothing. They treat metals as random tickers. They trust that regulators always keep things smooth, and they assume that if something truly serious were happening, it would be front-page news. They might own some paper metal through funds or certificates and believe that is good enough. The second type reacts emotionally in exactly the way the system prefers. They chase price spikes with leveraged futures or options, then get shaken out by the next engineered downdraft. They live on margin, they focus on daily moves, and they become a source of cheap liquidity every time the algorithms need someone to. Take the other side. The third type steps back and looks at the structure. They understand that the core story here is not a one-day price pump. It is a re-rating of what counts as real collateral and what does not. They realize that in a world where paper promises on metal are forced to line up with physical reality, owning claims that can be cashed, settled, or frozen is not the same as owning ounces in hand. I am not going to tell you which type to be. That is your call. I can tell you which one I try to be. I focus on survival, not hero trades. I avoid leverage where one wrong move wipes me out, and I treat physical metal as insurance against the exact kind of rule change we are talking about, not as a day trading toy. 6 months from now, when you look back at this weekend, one of two broad narratives is going to be obvious. In one version, regulators and banks manage to muddle through. They find enough capital, they slow walk enforcement, they massage the rules just enough that the headlines stay calm. Silver will still have moved higher over time, premiums will still be sticky, and the fractional games will continue in a weaker form. In the other version, something snaps. Maybe one bullion bank misjudges its exposures and fails a funding test. Maybe a delivery default forces an exchange to declare that contracts can only be settled in cash. Maybe a central bank decides it would rather be first through the door than last, and starts hoovering up whatever physical supply is left. If even one of those triggers fires, the separation between paper price and physical reality becomes undeniable in the open. The premium for real metal can gap far above the screen quote, not by a few percentage points, but by multiples. And once that happens, you are going to see a rush of people trying to move from the first two categories into the third, all at once, in a market that simply does not have the inventory to accommodate them. Do not wait for a talking head on television to give you permission to think this through. Right now, before Monday, you have time to make simple decisions with a clear head. How much of your so-called metal exposure is really just paper? How much of your savings is trapped in instruments that rely on counterparties and central bank goodwill? How would you feel if a rule change or a force majeure clause turned a large position into a small cash payout while the street price of metal kept running? I am not your financial advisor. I cannot tell you what to buy or sell. I can only show you the fault lines. Here is what I am doing. I am not chasing every uptick with margin. I am not shorting silver, hoping the banks win another round. I am making sure that a reasonable slice of my wealth is held in forms that do not need anyone's permission to settle. Actual coins, actual bars, stored in ways that I can access without begging a broker. If you choose to do nothing, that is still a choice. Just make it conscious. If you choose to move, move before the crowd. Take a screenshot of this video or save the link somewhere you can find it. In a year or two, when people call whatever comes next an unforeseeable shock, you can pull this back up and remember that the clues were sitting in a dry regulatory document long before the headlines blew up. Subscribe to the channel, turn on notifications, and share this with one person who you know has been banging their head against the metals market for years, wondering why every rally seems to get ambushed. They deserve to see the structural story behind the noise. Do not let yourself be the last one in line trying to convert paper promises into real value. Because on Monday morning, when that Basel III funding rule finally bites down on the balance sheets of the big players, the game changes. And the people who understand how the game was rigged are the ones with the best chance to walk away with something real.